Right. Morning, everyone. Right. Okay, welcome back to Morning Kappa again. Okay, Aiman here. All right. So, well, if you look at the S&P 500 close higher on Thursday session, raising about 0.2 percent. But this marks a sharp decline in tech stocks, which, if you can see here, Nasdaq dropped 0.3%, driven by a renewed AI bubble fear after Oracle missed revenue estimates. Right, so Oracle plunged over 10% yesterday, dragging down Nvidia as well, as investors punish the company for massive AI spending that haven't yet translated into sufficient profit. So, I think, however, market the capital didn't leave the market, right? Well, it rotated into financial, industrial, and materials as well, which surge as traders bet for that lower interest rate will boost the broader economy, which makes the S&P in a positive sentiment. So, let's see if today's session could push the market higher to test the resistance at 6950 points for the S&P 500. Okay, so for the China A50 futures, right? Well, it traded Thursday session or yesterday, reversing the morning gains as investors sold the news, so-called sold the news, right? For the Fed rate cut. Uh, I think disappointed that it didn't spark immediately the inflows as well, right? So yeah, sentiment was battered by the plunge in ZTE Corporation, which dragged down the tech sector as well after report shows that it may face a US fine for uh, bribery, coupled with heavy profit taking in the property stocks as well. So the market remained in the defensive uh, throughout the session yesterday, waiting for the official outcome from the conference, which concluded after the market closed, right? So, however, looking at today's session, I think the future seems a bit bullish, rebounding from yesterday's close and currently eyeing for the 15,500 points level. Right. So for the WTI crude oil futures, well, it fell on yesterday's session. Fell on yesterday's session after the energy agency monthly report forecasted a surplus in 2026, confirming that the non-OPEC supply growth will vastly outpace the demand. So prices were further pressured by reports of progress in Ukraine peace talks as well, which sparked fear that sanction on the Russian oil could be lifted, flooding the market with supply. So, this bearish structural theme completely overshadowed the short-term support from the recent Fed rate cut. And if you look at the chart here, from yesterday's session, WTI tested the 57 dollar level but unable to cross lower. So, we're still holding a negative trading bias, targeting the 57 and also 55 dollar level. So coming back to Malaysia, well, looking at the FKLI, well, it surged 17 points or adding up to 1.05% on yesterday's session to close at 1629 points, chairing the US rate cut of 25 basis point and Powell's assurance that rate hikes are off the table, right? So Malaysia outperformed or the regional peers, driven by massive rally in tech as well, and broad buying in the blue chips. As I think, I believe foreign fund return to raise assets, right? However, gains were capped in the construction sector with Gamuda. If you can see here, Gamuda falling almost 4%, over 4%, on profit taking as investors rotated capital from high flyers into laggards, right? So now that the bull have returned, we're holding firm to our positive trading bias, with resistance now seen at 1650, followed by 1675 points level. So this is our watch list. Well, I think for those that joined our morning kappa yesterday, that follow Ching, well, congrats. Right. Yeah, I think for Malaysia trading stocks, yeah, stay tuned for our Malaysia trading stocks as it is still on pending approval. So I'll post it in the chat group later. Yeah. For maybe I can if I can share a bit on this stock, right? That I just screened through just now. So which is Maxis. So if you can look at the chart here, I deem that the correction is completed after it has rebound from the golden Fibonacci ratio level. So if any of you are still new here, golden ratio is that is what I always refer to, 50 to 61% level, right? And now for a better confirmation, to me personally, I will wait for the stock to cross above 50 day, this blue color line, 50-day SMA line, to give us just a confirmation, right? So well, if it managed to climb higher, for ringgit and as well as for ringgit and 10 cent level is a strong resistance level at this juncture. Okay, so finally looking at the FCPO, well, the future, the FCPO failed to sustain its early rebound on Thursday, giving back nearly all the gains to close flat as poor export data weigh heavily on the sentiment. So the market initially rallied on the arrival oil price, but buying interest shrink as ringgit strengthened, and traders refocus on the massive stockpiles report yesterday by MPOB, right? So the inability for the FCPO to hold gains despite supportive external market is, I would say, a bearish signal, confirming that the local supply glut is dominated the narrative or sentiment, right? So as such, we continue to hold our negative trading bias, aiming for the 4,000 ringgit level support, and also the 3,900 support level. Yeah, so I'll stop here and pass the floor to Alex for his 2026 market outlook. Thanks, everyone, and happy trading. See you guys next week.
Okay, thanks, Aiman. Good morning, everyone. Thank you for dialing into today's edition of Morning Kappa at 8. We've just published our 2026 market strategy report. Take a look at the report for greater granularity. But I think to summarize it in 3 minutes, essentially going forward into 2026, we are constructive on the outlook for equities in 2026. The positive base case economics house view, on both global and domestic macro situation, is a relatively solid one. For the US, RHB Economics is forecasting GDP growth of 1.9% in 2025, 2% in 2026. For Malaysia, we have GDP growth estimates of 4.7% for this year and next year, which is a touch higher than consensus. and certainly a fair amount higher than the MOF's own forecasts for 2026, which currently stands at 4 to 4.5% GDP growth. So essentially, the positive house view is predicated on the start of the US rate cut cycle, easing dollar trends, better clarity on tariffs, a solid trade environment, easing trade tensions, and obviously resilient domestic demand, and continuing strong commitment from the government to sustain pro-growth business conditions, and a potential general election within the next 20 months. That implies minimum regulatory risks in terms of new tax reforms from here on out, for example. So I think while we are constructive on the outlook for equities, I think we have to temper some of that optimism, to recognize some of the global macroeconomic risks that are coming out from the US in particular. And obviously we see quite a few risks here. You can read about it in the report in more detail. Risks include the US economy undershooting expectations, because of the tariffs implying impacting the inflationary situation. The Fed has just this week cut rates by 25%. That could actually, without the proper U.S. economic data, given the recent shutdown, and right now, there's a risk that the rate cut will exacerbate the inflationary situation. The other risks include a further out a potential U.S. financial market pullback. We are looking at a potential the risk. We cannot ignore the risks of another government shutdown, because the U.S. government is currently only funded through the end of January next year, unless Congress and Donald Trump approves some of the appropriation bills. We are also waiting for the Supreme Court decision on the legality of the U.S. tariffs. We need to be careful what we wish for, because if the Supreme Court rules the Liberation Day tariffs illegal, then we are going to see a situation where the U.S. government has to repay up to $200 billion of tariffs that have already been collected. And with the government already in a huge net debt situation, the government, the U.S. Treasury will just have to print more, issue more U.S. Treasury bills to even pay back the $200 billion worth of the money that the tariffs have been collected. And of course, that will also torpedo Donald Trump's efforts to squeeze countries like Korea and Japan to spend money to reshore manufacturing into the U.S. On the threat of more tariffs. But if the tariff overhang is removed, then there's certainly no more coercive incentive for Korea and Japan to actually do that. Elsewhere, also, we also need to be aware of what the BOJ is doing with regards to interest rates in Japan, because that will have implications for the U.S. bond market, given that Japan is the largest foreign owner of U.S. treasuries. Okay, so I think we need to watch the macroeconomic picture very carefully, while the house view is a relatively sanguine one. But I think we need to read between the lines to look at risk, because if inflation goes higher, growth will slow, and complicates the monetary policy narrative going forward. And of course, there are also risks of the bond market losing faith in the independence of the Fed, because Jerome Powell's term as Fed chairman will end next May. And the front runner to be the next Fed chair, this guy called Kevin Hassett, he is a huge dove for interest rates, and it could then result in the Fed cutting rates even further in 2026, and obviously that will lead to potential spike in inflation, and of course a much weaker US dollar as well. Okay, so I think overall we would be looking in terms of investment themes, we would be looking to be constructive on equities, as I mentioned, but we need to be really cautious to not chase the winners. We should be looking. I think markets in 2026 will be a very trading oriented market. Stock selection will be key. We need to look for opportunities to buy on weakness, to look at the laggards, and I think some of the small cap stocks are beginning to show some degree of value, given that the FBMSC is already trading at a 4 to 5 PE multiple discount to the big caps. Okay, so we have a year-end target of 1720 and 2026, derived from applying a 15-time target PE to FY27 EPS. All right, so take a look at the report, and we will have more engagement sessions in January when we all get back from our leave. Okay, that's it for this morning. Thanks for dialing in to Morning Cup at 8, and I'll see you. Hope to see you dialed in next Monday. All right, thank you so much. Have a great weekend. Cheers.